In 2001, one of America's most admired companies vanished. Not slowly, not quietly, but in a matter of weeks. It had been called the most innovative company in America for 6 straight years. Wall Street loved it, politicians praised it, employees believed in it. And then it collapsed into the largest corporate bankruptcy in U.S. history. This is the story of Enron. In the 1990s, Enron wasn't just an energy company. It was positioned as a revolution. Originally formed from a merger between Houston Natural Gas and Internorth, Enron transformed itself into an energy trading giant. Instead of simply selling gas and electricity, it created markets. It traded energy contracts like stocks. It promised efficiency, innovation, and massive growth. At the center of it all was CEO Jeffrey Skilling. Confident, brilliant, aggressive. He promoted a culture that rewarded risk-taking. Employees were ranked constantly. The lowest performers were fired. Only the bold survived. On paper, Enron looked unstoppable. By 2000, its stock had soared above $90 per share. Its market value exceeded $60 billion. It appeared invincible. But the profits were not as strong as they seemed. Enron used a method called mark-to-market accounting. This allowed the company to record projected future profits immediately. If Enron signed a 10-year contract, it could book the estimated total profit on day one, even if no cash had actually been earned. Profits looked huge. Stock prices surged. Executives received bonuses. But much of the money wasn't real. To hide growing debt, Enron created hundreds of off-the-books partnerships called special purpose entities. These entities carried the company's liabilities, so Enron's balance sheet looked clean. Investors saw growth, but behind the scenes, debt was rising and losses were growing. In early 2001, insiders began quietly selling their shares. At the same time, employees were encouraged to invest heavily in Enron stock for their retirement accounts. Many trusted the company completely. Then, analysts began asking questions. A Fortune magazine article questioned whether Enron was overpriced. Credit rating agencies took notice. Investors grew nervous. And when trust starts to weaken in financial markets, collapse accelerates. In October 2001, Enron announced a $1 billion loss. Then more losses followed. Hidden debt was revealed. The stock price began falling rapidly, from $90 to $60, from $60 to $30, then to $10, and within weeks, it fell below $1. Banks refused to lend. Trading partners backed away. Confidence disappeared. On December 2, 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. Thousands of employees lost their jobs. Many lost their life savings because their retirement funds were invested heavily in company stock, while executives had already sold millions worth of shares before the collapse. The scandal exposed major failures in corporate governance and accounting oversight. The accounting firm Arthur Andersen, which audited Enron, was found guilty of obstructing justice for shredding documents. The firm later collapsed. Executives were prosecuted. Chairman Kenneth Lay was convicted but died before sentencing. Jeffrey Skilling was sentenced to prison. In response, the U.S. government passed the Sarbanes-Oxley Act in 2002 to increase corporate transparency and accountability. But the deeper lesson of Enron goes beyond fraud. It was about incentives. When executive bonuses depend on stock prices, short-term growth becomes more important than long-term stability. When financial systems become complex, risk becomes harder to see. When everyone is making money, few people ask difficult questions. Enron did not collapse because markets failed. It collapsed because trust failed. And trust is the foundation of every financial system. Once trust disappears, numbers don't matter. Revenue doesn't matter. Innovation doesn't matter. Everything falls. And that's how one of America's most admired companies became one of its biggest corporate disasters.